Chris Cottrell with Paul Hastings.
Excellent, and I appreciate you joining the program here. And I tell you, I got a recent blog post, guest post, written article. I guess I'm not even really sure how to phrase them these days because so many blog posts are written better than articles are in newspapers. So I hate to detract from one to do to the other, but that's what we're going to kind of talk about a little bit. You called it fracking's secret problem. I guess debunked fracking's secret problem. So first of all, let's start off by introducing yourself a little bit, and then we'll go into the debunked fracking secret problem and kind of go from there a little bit. So where are you located?
So I'm located in Houston, Texas.
Okay.
I'm a energy mergers and acquisitions attorney, which basically means that I help energy-related companies buy and sell assets, and I work for a firm called Paul Hastings.
Okay, so it's safe to say that you got your finger on the pulse of a lot of mergers, acquisitions, energy talk, that sort of thing, and you're able to filter through which is hearsay, scuttlebutt, and which ones are probably more likely to happen than not. Would that be fair to say?
Well, we try to do our best to stay close to our clients and hear what's going on and keep our ear to the ground.
Okay. Well, let's talk about your column here, Debunked Fracking Secret Problem. Just, I guess, what led you to, I guess, have that title? I mean, there's kind of a lot in there. You got debunked and secret, so it's very eye-catching is what I'm getting at.
Yeah, so as you know, oil prices have come down from, high of 75 at the beginning of October, all the way down to 45 at the end of the year. Seems like prices have stabilized a bit at 50, but at any time you see a big price drop in the industry, there seems to be a lot of articles written, kind of trashing the industry and trying to pull facts and figures to kind of misrepresent the truth. I was going through my news feed one morning, and I came across this Wall Street Journal article, and it was titled "Fracking's Secret Problem: Oil Wells Aren't Producing as Much as Forecasted." So that was published last week, January 2nd, and after going through it, I felt that it was mischaracterized a lot about our industry, and I felt that someone needed to, make it clear,
And you're talking about the Wall Street Journal's article, the one that Fracking's Secret Problem, correct?
Yes, absolutely.
Yep. Okay, and in their deal, they were just, like you said, they were talking about the oil wells aren't producing as much, which is not a new finding. I mean, the wells have been having a pretty steep drop off since 6, 7, 8 years ago, since they really started doing a lot of the fracking and hydraulic fracturing, that sort of thing. Let's talk a little bit before we, I guess, get too far. A little bit of a sidebar. What did you make of the Wall Street Journal article? I guess.
Well, I think you're right. I think on average, it's pretty well known that some wells in some shale plays aren't producing what was expected. I guess a surprising thing for me was that it seemed like the Wall Street Journal article wasn't researched very well. And the other thing about the article was that it skewed a lot of the, background, the history in the industry, as well as a lot of the projections that they showed.
Well, what I've noticed, and this is going to be a total little sidebar here, the reason I kind of mentioned earlier about the blogs and how they seem to be, a lot of bloggers these days seem to be doing better journalism than a lot of the, journalists, I guess, is it almost seems like, the Wall Street Journal is telling you how to feel. And a lot of the bloggers and people like yourself are telling us facts, and so we can actually come to our own conclusions and make up our own mind. That's what I got out of that Wall Street Journal, is almost there was more emotion in there than there was fact. Do you know what I'm saying by that? Am I way off base?
Well, I definitely agree with it seems like it was a one-sided argument, right? There seems to be a shift, particularly when we read articles about the oil and gas industry. Every now and then you come across these articles that are just one-sided. They're not down the fairway. And, I don't know if you want to kind of talk about the article, but, essentially what they're arguing is that over time, it seems like the market has moved away from the way that they valued oil and gas companies in 2007 to where we are today, right? The market's valuing these companies at historic highs, and basically they're saying, well, it's because the industry is creating all this propaganda and false analysis of their proved reserves, which is about as far from the truth as you can get. And the other disappointing thing about the article is that at the very top it had a figure that they had made, I guess, but it only had about 6 companies on there, which really skews a lot of the analysis.
Sure. Let's talk a little bit about the SEC, if you wouldn't mind, a little bit, because they have to be involved here with a lot of the methodology and even the valuation portion of it. A lot of the rules and regulations have changed over the past decade. How does that play into all this when it comes to evaluating and coming out with even prognosticating what's going to happen?
Yeah, absolutely. So that's a really good point. The SEC came out with a ruling December 31st, 2008, and they came out with a new rule that essentially revised the disclosure requirements for oil and gas companies, related to their reserves. And what the SEC was trying to do is modernize and update the disclosure requirements to reflect the industry and the changes in the industry, the practices in the industry. And the other thing is that they feel it's very important to present investors with information that they're going to find valuable. So essentially, one of the changes that they adopted was that they were going to start having companies value their reserves on a 12-month, first of the day of the month historical average. After 2008. Before 2008, you were allowed to value reserves based on something called spot pricing. And what spot pricing is pricing on the one day, the spot pricing for the one single day, and they were allowed to value their reserves on the last day of the year for the prior year.
How does investors play into this? Have you've seen them increase, drop, I guess, when it comes to these different rules and regulations and inflated pricing and that sort of thing? What are investors saying in this whole thing? Are they investing, not investing, waiting to see? I guess just kind of from the investment standpoint, because I do want to ask you about the word uncertainty as well, because that word has been coming up more and more in the last few months, and that's what they used during the last downturn was uncertainty. So let's talk about the investment side of things. Just kind of what are some of your investors saying about either the article or just kind of some of the sentiments, either from what you're arguing or what the Wall Street Journal is trying to put out there?
Well, so if you apply the rules Well, let me back up for a second. I think we know that there's, in general in the stock market, there's a little bit of turbulence right now that hopefully is correcting as we begin this year. There's global trade issues. There's a lot of things that go into, what affects the financial markets. But I think overall we can agree that there's some turbulence right now.
Sure.
Applying that to the oil and gas industry, obviously, we're experiencing a downturn in pricing. So, mix the global issues with the pricing. We got hit particularly hard, at the end of last year, and so far this, the beginning of 2019. If you take the SEC methodology, it can produce kind of funny results. I think you kind of see that in the Wall Street Journal article. But I'll throw some numbers out at you, and you can understand kind of the situation. So if you go back to January 1st of 2007, prices were right at about $60 a barrel. And you fast forward to the end of the year in 2007, and prices were right at $95 a barrel. And the average for the entire year was about $71. If you fast forward to 2017, prices were at the beginning of the year at $52. They raised to $60 at the end of 2017, and the average for 2017 was $51. And so I know that's confusing, but essentially what you have to ask yourself is, if you're an investor in 2017, you see prices start at $52, end at $60. Do you think prices will continue to rise, past 60, or are they going to fall back to the average of 2017, which was 51, right? And so I think a lot of people were predicting prices to continue to increase in 2018, which they did, up until October. And, going back to 2007, if they had the rules at that time, they would have had to value the reserves at $71 for that year, but prices finished out strong at $95. So if you can book your reserves at $95 a barrel, obviously you're going to get a much higher number than if you're booking reserves at 51. Right? So effectively what you're getting is, a year that could close very strong with pricing, like in 2017 at 60, but you're still stuck at the 51 number, and it could artificially lower the reserve value for these companies. Sure.
Chris Cottrell with Paul Hastings, mergers acquisitions attorney. We're talking a little bit about some of the activity happening in the oil and gas industry, as well as, I would say, behind the scenes as well. Every time there seems to be a downturn, there does seem to be some mergers and acquisitions. Just kind of seems to be the nature of the beast, whether it's centralization or whatever the case might be. I think the last time it was a Baker Hughes and Halliburton even. So, I mean, it seems like everybody's open for mergers and acquisitions during these times. I wanted to ask you about the steel tariffs. And I don't know if you guys have done any talk on this or heard anything from your clients or colleagues, but I've heard a few rumblings up here in the upper Midwest and in some of the Colorado Rockies and I should say the Rocky Mountain region, as well as the Bakken. Just some concerns because there's so much infrastructure projects going on with pipelines. And, of course, pipelines use steel. And, of course, there's a lot of midstream companies that use steel as well. And so their concerns are when the taxes or the tariffs or whatever kick in. Have you heard anything in discussion when it comes to any sort of new tariffs, taxes, fees, regulatory costs in the 2019?
That's left to be seen. I think you do hear a lot of grumblings. I think people want those tariffs to be lifted. They want the market efficiency. They want the lowest pricing they can get for those goods. And so not only does it affect the midstream pipeline infrastructure projects, but it does to a certain extent affect upstream drilling, because steel's also involved in that process. So I think we all want to see the cheapest pricing possible.
Yeah, I don't think anybody really knows quite what to expect yet. I mean, they know it's coming, but they don't know what to do until it, I guess, hits, and a lot of costs are being absorbed, I guess. But it's interesting how that's going to play out. That's one of those things I've been watching, because that seems to be a little bit different during this downturn than, say, the last one. I mean, up in the Bakken, where I'm located, the last downturn, they still were drilling about 1 million barrels a day. So they were able to go down to almost like a pulse of rig count, but they were still able to produce quite a bit with low prices. So to me, that just seemed like the industry changed a little bit to where they almost had a little bit more predictability as opposed to the boom-bust cycle than it was back in the 80s and that sort of thing. Have you guys noticed that at all with any of your clients, that the new age of oil or the modern shale play? Have anybody commented on how that's different over the last 20, 30 years?
Yeah, I mean, the shale plays, it's truly a phenomenal success story. And, one thing I want your listeners to realize or think about is the fact that shale plays are not unique to the United States. Okay, it's a global resource. But despite that fact, you only see the real development happening in the United States, and that's probably because it's truly an American story about us having the best, the brightest, the most talented people, and being able to be entrepreneurial, get out there, develop this resource, and come up with innovations, find ways to get product out of the ground for less money, and that's ultimately what everybody's goal is. But if you look back from the 80s to today, I don't think anybody would have predicted the production growth that we're seeing today. It's just phenomenal.
That's an interesting point that I think a lot of people forget, is that fracking doesn't just happen in the United States. It can happen all over the globe. I know that the UK is banned it primarily for the most part, but some of the emerging countries, I can imagine that they're only going to be increasing their hydraulic fracturing and energy production over the next decade, as we either teach them how, or our global companies go over there and go make some of their own money that way, I guess. But you're right, it's an American phenomenon. But I do think a lot of the other countries, with Europe as a wild card, they're going to start doing it pretty soon, aren't they?
I'm not too familiar with the overseas development, but I will say, it probably is a matter of time before we see, other shale resources. You heard some rumors about the Vaca Muerta in Argentina, and their government was trying to incentivize people to go down and develop that shale resource. So, that is out there. I'm sure in the near future we'll see that. But at the end of the day, I think Americans see the value. I think that the market sees the value in the United States. Our ability to be entrepreneurial and keep expenses down. We're head and shoulders above the competition when it comes to oil and gas.
Of course, a lot of the reasons we're talking about this is because of a recent article in the Wall Street Journal talking about fracking's secret, and Mr. Cottrell has written a kind of a debunking piece of that, explaining how we've kind of changed the way that we evaluate companies these days, and it has to do with some SEC regulations and rule changes, et cetera. And then one thing I do want to ask you about before we wrap up the interview is EURs. You met in our correspondence back and forth. You mentioned that you wanted to discuss that. What are they? And talk to me a little bit about that a little bit, because they seem to be pretty important for people to know.
Yeah, I appreciate you bringing that up, because I do want to talk about that. So in the Wall Street Journal article, they talked about, this concept of EUR, and if you read the article, you'd think we invented it in 2014, right? They were saying that we came up with it as a way to overcome low oil prices. Well, I'm here to tell you that EUR calculations have been around for a long time, and what they are is the estimated or expected ultimate recovery, and it's a calculated recovery of what you can eventually get out of a well or a field or a basin. And so, essentially the way that the EUR is calculated is by, drilling, developing, completing wells, and as wells come online, the engineers monitor how much production is coming out of the well reservoir, and they are able to estimate over the life of the well what that well will produce. And sometimes the more data you have, the better and more stable your EUR calculations are going to be. But if you're early on in a play, it's much harder to have that kind of production data to get a really good feeling of what you're ultimately going to recover. And so I think that's one thing that the Wall Street Journal kind of harped on. Again, I think companies have done a good job of disclosing the fact that those calculations are, they can be very speculative, and they're very clear with their investors that their calculations are can't be disclosed to the SEC through the SEC, and it's purely a way for them to demonstrate how what their technical team believes could be possible.
And EUR stands for what again?
So some people call it estimated, some people call it expected, but it's the estimated or expected ultimate recovery.
Okay.
Related to oil and gas.
Right.
So what you ultimately think you're going to get out of the ground.
Well, I'll tell you what, the one thing I am happy to hear about all this, and I wish some of the bigger companies like the Wall Street Journal and the 24-hour news networks, the people that already have the eyeballs and ears, I wish they would have more of a conversation of figuring out ways to recalculate these types of things. On our program, about 5 years ago, we started asking the question, should we, eliminate rig counts or rethink how we look at rig counts, because the numbers just didn't seem to be matching up what the projections were and the predictions, and they just seemed to be off so much. And kind of what you're talking about is another one of those examples of how the world of oil and gas has changed. Technology, innovation, the legal side of things. I mean, we do a weekly program or weekly update from the Meridian Energy Group on the Davis refinery, and they've spent the last year and a half in court over a number of different air permits, et cetera, and they just say it's the new normal in energy. Anytime you're starting a new facility up, it just seems like for a year you're tied up in court. So, I mean, when I take a look at all these different costs and some of the new innovations to offset those costs, and how rig counts aren't what they used to be due to the either decline on the well or the crawling, walking rigs and all these different things. Anyway, it just seems to me like we need to almost reinvent or rethink how we do pricing and speculation and that sort of thing. And it sounds to me like you guys are already talking about this. Am I right on that we should be having more of a conversation nationally about this, or is it just am I out to lunch, I guess?
No, I think you're exactly right. It's one of those things where, going back to the SEC rules, that there have been a lot of, folks that are critical of the rule because, you can only book proved reserves that you can develop within 5 years. And we know that shale plays take much longer than 5 years to fully develop. And it definitely limits how many reserves you can book into that proved category. And I think you're seeing that reflected in the share prices of these oil and gas companies, right? So, even though they can only book so much in reserves, I think investors, are valuing it at a much higher number, primarily because they understand that the companies are limited as to what they can book as proved reserves. And that I think should tell you that we need more modern, updated, rules that reflect that.
Yeah, I just look at it like, everything else has, gotten a 2.0, 3.0, that sort of thing. This seems like something that should be as well. I don't know what the answer is, and I always feel bad anytime pointing a finger at something without coming up with a solution. I'd hate to be a finger pointer. I like to be a solution bringer. But just something like this, I think we've gotten to the point to where some of the experts, either in the economic side or the industry side, should start having that conversation too. I know they are behind the scenes a little bit, but I think collectively they need to. It's hard, though. It's hard to change momentum. It's really hard to change a thought process. Like I was having a conversation the other day with Michelle Comer. She's the North Dakota labor secretary and or labor commissioner, and they've got a real problem in North Dakota because there's so many jobs that they're now coming out and saying that, maybe you should consider a 2-year degree instead of a 4-year degree, or a 4-year degree is not for everyone, that type of thing. It's a 40-year mindset we got to start thinking differently about. And I think that's the case in the energy industry too. There's some different mindsets I think we need, especially, you remember the old days, how what's the name of that? Harry the Dirty Dog, running through the energy plants and getting all dirty and everything. Even that needs to change, some of the new green, clean, innovative techniques they've got have made some of this energy production extremely clean. So anyway, sorry, I like to sidebar sometimes here, so you can just tell me to shut up. But let's talk about 2019 a little bit, because really at the end of the day, what we're trying to do is put together all these facts and figures, speculations and prognostications, and come up with kind of a guideline for 2019, or at least some milestones, some hitch posts, or some talking points, that sort of thing. So what are you looking at for 2019?
So, I don't have any predictions on pricing, but, I think, and I hope that prices do improve over time. I think, that we're well due to get pricing, particularly above $50. So, that's a hope for 2019. If you try to measure what's going to happen in 2019 by the early indications from what companies are saying their budget's going to be for 2019, I think you're starting to see some companies come out and say, well, we're going to do the same as 2018. We're going to spend the same as 2018. You got other companies that are saying they're going to spend more. So, I think you're going to see continued development continued spending, and hopefully we're going to see, more companies focus on costs, focus on margins, focus on creating cash flow, lowering the cost of development, and then also, keeping debt levels down and trying to find ways to operate their oil and gas wells more efficiently. And I think we're just going to see things get, cheaper, better, faster, stronger in 2019.
Now, I don't know if you can comment on this because this is actually your industry, and I don't know how much of it gets you in trouble, or if you can actually use it as, hey, I know a lot about what's going on in this industry. Mergers and acquisitions, you're an attorney in the mergers and acquisitions world, so I don't want to get you in any trouble. But at the same time, anytime there's downturns in pricing, we do have mergers and acquisitions. Like I said last time, Halliburton and Baker Hughes. And on outside of the oil and gas world, Bayer and Monsanto. So, you're talking about some of the major kings of the economy, and not only the industry, but the economy that ended up going through an M&A. 2019, do you think it'll be kind of a year for M&A, or do you think that was last year? How are you looking at the mergers and acquisitions activity? The more the merrier for you. I'm sure that keeps you busy.
No, absolutely. I think if I had to make a prediction for 2019, you're going to see continued M&A activity, in the lower to middle market. Smaller and mid-sized companies are going to be, buying and selling each other. I think you're going to be. 2018 was a year where there was huge deals, really big billion-dollar plus, multi-billion-dollar deals. I don't think you're going to see as much of that in 2019. A lot of the bigger guys, they have a lot of inventory, and there's just not really a need right now to acquire additional parties. With that being said, I think if they could get a really good deal and get good pricing, I'm sure we may see some bigger deals, but I don't think we'll see as many.
Kind of wrapping up here a little bit, we have Chris Cottrell with us, and he's written a column debunking the Wall Street Journal's fracking secret problem. He's a M&A, mergers and acquisitions attorney. Paul Hastings is the name of the company. Paul Hastings, LLP, to be a little more exact. And just kind of, I'd like to give guests the final word. Anything that we missed, anything you want to reiterate, if you want to, plug your blog, that sort of thing. If you want to do all of the above, I just like to give guests the final word, and so the question is not framed by me, if you will. So the floor is yours, sir.
Sure. I appreciate that opportunity. If your listeners are interested, the head of our practice group, his name is Jimmy Valley. It's spelled, Jimmy, last name Valley, Vallee. But he has a website called jimmyvalley.com. He has a great book that he wrote last year called Giant Shifts. I'd like to urge all your listeners to pick up a copy and take it home with them. It's got some really interesting things about the things that are happening in energy and the shift that's going on, and kind of some predictions for the future.
Wait a minute, who's Jimmy Valley? I'm looking at the website here. Jimmy Valley, an American energy M&A lawyer and commentator. And he also goes around the country speaking. Is that what he does?
Yeah, Jimmy's been in the industry for a long time. He's he's my boss, and he's probably done, if he hasn't hit the $100 billion mark in deals, he's pretty close.
Wow.
He's he's an incredible M&A attorney. Basically, the best in the business, in my opinion. and he's just on the cutting edge of everything, and I'm just excited to be on his team.
Boy, this guy seems, I'm just reading up on him here, and energy trends reshaping America's future. I couldn't agree more. I mean, I honestly believe that when it's all said and done 100 years from now, and our grandkids are reading, or great grandkids or whatever are reading in their history books, this will be known as the shale age, or the fracking age, if you will, just like the iron era and the Bronze Age and everything. I really believe that's how historic this is right now. I mean, the way that we are redoing our infrastructure. I mean, out in a lot of these rural areas, they're getting roads for the first time. I mean, when you think about that, a lot of these rural areas where the fracking is going on, they only had a couple combines a year go down those roads. Now they got semis going down. So, I mean, we're really rebuilding a lot of America's infrastructure. So, anyway, like I said, I sidebar a lot. And Jimmy Valley, you kind of got me excited here as I was kind of looking over the website. So, hey, give him a plug. How often does he speak? What's the email address and the website and everything so people can book him?
Well, the website's jimmyvalley.com, and you can also find his profile on our firm's website at paulhastings.com, and his email address is also on there, as well as his phone number. But he's talked all over the United States. He's done like several speeches. You know what the Mensa organization is for high IQ.
Yep.
So he's done a few of those keynote speeches, and he's really in the corner of the oil and gas industry. He's somebody that goes out and tries to get our message out there, and encourages, positivity about our industry.
All right, and then one last time, people, if you want to get in touch with you, do you stay in touch with people through your email and blogs and social media and that sort of thing, or do you like not to be contacted?
No, absolutely. Would love your audience to feel free to reach out to me. My profile is also on our law firm website, and you can also email me at Christopher Cottrell at paulhastings.com.